Hello and welcome to the Morning Filter. I'm Susan Jabinski with Morningstar. Every Monday morning, I talk with Morningstar Research Services Chief U.S. Market Strategist Dave Sequeira about what investors should have on their radars, some new Morningstar research, and a few stock picks or pans for the week ahead. Now, before we get started, Dave and I wanted to let our audience know that we're putting together a special viewer and listener mailbag episode of The Morning Filter. So send us your questions at themorningfilter@morningstar.com, and we'll answer as many as we can. And as a reminder, Dave cannot give personalized portfolio advice. All right, Dave, good morning. Before we get to the week ahead, let's first talk about last week's market activity. Stocks finished the week down more than 3% on tariff uncertainty. So what's your take on the market's response to the fluid tariff situation?
Hey, good morning, Susan. Yes, the headlines are all about tariffs, but I think the market reaction is really much more than just being only about the tariff situation. So if you remember, in our 2025 outlook, we had noted that valuations were getting too stretched coming into the year. The market was trading at about a 4% premium over a composite of our fair values. And we also had talked about how those tailwinds that had propelled the markets in 2024, were all slowing coming into this year. And of course, we are looking at the rate of economic growth slowing. We're expecting three sequential quarters of growth, slowing this year as well. And then on top of all of that, you add in, the added uncertainty from the tariff situation. So again, I think there's a lot more, going on here than just the tariffs in and of themselves. And then also, I was looking at the charts over the weekend, and I think there's also some concern in the market about the potential impact from the focus on cutting government spending. If you were to look at government spending or federal spending as a percent of GDP, I think it was 24% in 2024. Looking back further, it was only 20% pre-pandemic. And even before that, it was lower, probably in the upper teens going back towards like the global financial crisis and before that. So, having said all that, I think investors also need to look, below the surface. When I take a look at the market, over the course of the year, coming into the year, we actually had recommended to overweight value, underweight growth. So right now, the Morningstar U.S. Market Index, which is our broadest measure of the overall market, is down about 2% year to date. Value stocks are actually up 4.2%, whereas growth stocks are down, almost 6%.
So has Morningstar yet made any changes to its fair value estimates on companies because of the tariffs?
Not yet. And in my mind, I just don't think there's enough specificity and clarity as to what the final resolution is going to be, on all of the tariff negotiations, that are going on. So in my mind, in order to really incorporate, those potential changes in tariffs into valuations, there's a lot of things that we need to know. We need to know what products are included, what products might be excluded, what the amount or the percentage of the tariffs are going to be. We need to have an idea of how long we think that they're going to be in place. And of course, what kind of retaliatory tariffs might be put in place, as well. So in my own mind, when I'm thinking about what's going on right now, thinking about like the existing 25% tariffs on Canadian and Mexican products and goods, I just don't think that's going to be what the final tariffs are going to be once this is all settled.
Now, last week, we also had jobs numbers come out, and they came out lower than expected. So unpack them for us.
Yeah, payrolls came out at 151,000, as you noted, slightly less than what expectations were. I would just say at this point, in our view, it's still too early to see the impact of potential job reductions across the federal government departments. So when you get into the underlying numbers here, the government sector actually added 11,000 jobs in this last payroll report, even though, you had federal government payrolls declined by 10,000. So I think next month is where we'll probably first really start to see that potential impact. Looking at some of the other indicators here, the unemployment rate came in at 4.1%, a little bit higher than the 4% the last report. But really, as you know, the thing I consider to be most important right now to the markets and the economy is going to be wage growth. So that did come in 4% year over year, slightly than expectations, but still ahead of core PCE, which was 2.6% on a year over year basis earlier this month. So to me, that is a positive development. I still think we need to see additional wage growth just in order to help increase purchasing power among households, especially in lower income and middle income households.
So then, Dave, what impact do you think these jobs numbers will have on the Fed's rate decision at the March meeting?
Yeah, I don't think it's going to make any impact. I don't think we're looking for a change, at the federal funds rate, in the March meeting. It looks like the market implied probability of the Fed cutting in May is a little bit under 40% right now, but I know our U.S. Economics Department is still looking for a 25 basis point cut in May.
So let's shift over to this week now, and we have February CPI and PPI numbers coming out. So what's the market expecting, and is it likely that tariff talks will have any impact on those numbers?
I don't think there's going to be really much impact of the tariff talk, just yet. But CPI is expected at least to be moving in the right direction. So I think consensus for headline CPI on a year-over-year basis is 2.9%, a little bit lower than the prior 3% print. And then core CPI coming out at 3.1% on a year-over-year basis, so better than the 3.3% we had last month.
Now we have a couple of companies reporting this week that you're keeping an eye on. The first is Dollar General. Now the company's been under pressure due to a couple of different factors. Tell us about that.
Yeah, and this has really been a multi-year story in how it's playing out. So Dollar General initially did okay, when inflation was increasing, back in 2021 and 2022. Cash-strapped consumers, were switching to dollar stores. And inflation at that point in time was reducing purchasing power, and so consumers were only able to buy smaller individual units at a time. Now, as inflation continued to compound itself in 2023 and 2024, consumers were feeling even more and more purchasing power, kind of reduction for like what they're able to spend, coming out of their wallet. So as such, what we saw was that consumer spending had become, much more focused on consumables such as food and less on discretionary items. And unfortunately for the dollar stores, food is a lower margin business, discretionary is a higher margin business. So you had this negative mix shift, which hit their operating earnings and of course, hit their bottom line as well.
Now, Dollar General stock is down 47% over the past year. Looks really undervalued, according to Morningstar today. So what's your take on it ahead of earnings?
It does. It trades at a 29% discount. It's a 5-star rated stock. It still provides just under a 3% dividend yield. It is a company we rate with a narrow economic moat. We have a medium uncertainty rating on the stock. So I think the longer term investment thesis here is, there is upside once consumer purchasing patterns, begin to normalize as wage inflation helps restore that purchasing power. Now, I got to admit, the stock was up like 7.4% last Friday. I did a quick search. I don't know why. I didn't find any actual news that I thought would make it move up that much. So it could mean, a couple of different things that might be going on, coming into earnings. Maybe someone for some reason, think the earnings are going to look, really good, this quarter. And so they're trying to get ahead of that. Again, I would just note that this might introduce some added volatility to this earnings report when you have a movement like that, coming into the earnings release. Because of course, if the earnings for whatever reason are disappointing, that could lead to a pretty quick sell-off, after that big bump in the stock price.
Well, then it's definitely one to watch. All right, we also have Adobe, which is a stock we've talked about on the Morning Filter several times before, reporting earnings this week. Now, the stock fell hard last quarter after issuing a disappointing outlook for fiscal 2025. So what will you be listening for in the report?
Specifically, I'll be listening for how they're utilizing AI in order to help drive pricing increases, as well as being able to drive new consumer growth. Now, generally, their new products have been gaining traction, specifically the Acrobat AI Assistant and their Gen Studio, as well as Firefly. I know that Dan, who covers the stock for us, has specifically noted, he thought Firefly is well positioned, in artificial intelligence. I'll also be listening for additional color on how the company is faring using pricing as a lever within their tiered structure, really for, their core AI applications. And the recent price increases and product launches and some rapid Gen AI adoption, we think generally is going to drive, pretty good growth this year.
So then what's Morningstar think of Adobe's stock heading into earnings?
It's currently a 4-star rated stock at a 24% discount. Doesn't pay a dividend, so not necessarily appropriate for dividend investors, but it is a company we rate with a wide moat. Although, as with a lot of software and technology stocks, it does have a high uncertainty rating.
All right, moving on to some new research from Morningstar. We had Broadcom reporting earnings last week, and the stock rallied afterwards. So, what did Morningstar think of the report?
So earnings and guidance, for AI revenue did beat our expectations by a little bit. Overall revenue came in 25% up, year over year, 6% sequentially. And revenue tied specifically to AI, we think rose, 15% sequentially. So when you take a look at the company's guidance, we think that implies flat sequential revenue growth, but a 7% sequential growth rate in AI revenue. Now, I'd also have to highlight here too, we did raise our uncertainty rating to high. And the reason for increasing that is, the concentration of AI is becoming a higher percentage over their overall results. And so as such, we think that deserves that high uncertainty rating now.
So, is there an opportunity here today? Did Morningstar make any fair value changes to Broadcom stock?
We did, but I would say it's pretty minor, is only a 5% increase up to $200 per share for our fair value. Right now, it looks like the stock is trading pretty close to that, so it puts it in that 3-star territory.
Okay. So now we talked on last week's episode about how overpriced Costco was heading into earnings, and the stock did pull back after the company reported a revenue beat, but an earnings miss. So what was Morningstar's take on the results?
Overall, the results were pretty good. When you look at comp store sales, they were up 9%. That's a combination of a 6% growth in traffic and a 3% growth in their average ticket. And just to put that, into comparison, Walmart was up, 4.6% and Target was only up 1.5. So big increase, in comp store sales. Profitability expanded a little bit, increased 10 basis points. So the op margin went up to 3.6%. But this is still one of the more overvalued stocks in our mind. So again, fundamentally, the company is doing extremely well, but we think the market is just over extrapolating this short-term growth, too far into the future. It's currently a 1-star stock trading at a 72% premium. Just to put that in context, it trades at about 55 times our fiscal 2025 earnings estimate. So way, way up there as far as valuations go. And just when I take a look at our model here, and I don't think we're necessarily being overly cautious, we're forecasting comp store sales growth of fiscal 2025 still of 7%, much better than like a Walmart or a Target. And then over the long term, we're still modeling in comp store sales growth in kind of that mid-single digit over the long term. We're still looking for continued increases in the operating margin. So we're looking for that to get up to 5% by 2034. As you noted, the stock did finally start falling. So I don't know if maybe this is now finally the point that stock starts to roll over and, maybe starts continuing on a downward trend.
All right. We also had a couple names in cybersecurity, CrowdStrike and Zscaler report last week, but their stories were different. CrowdStrike stock tumbled after earnings, but Morningstar raised its fair value estimate on the stock. And then meanwhile, Zscaler rallied after earnings and Morningstar held its fair value. So explain it all for viewers, Dave.
Well, the stock prices did move around a bit, but fundamentally, nothing really changed that was significant enough, from our expectations to really change our mind on, cybersecurity and cybersecurity stocks, overall. CrowdStrike reported solid, fourth quarter earnings that included sales growth of, 25%. Now, operating margins here did contract, but a lot of that was just due to higher, operating costs, following their outage, in July. We think over time, those operating costs, will normalize. Now, in our view, the stock had probably gotten ahead of itself, and at this point, we just kind of think that that lower margin probably drove that negative sentiment here, in the short term. Taking a look at Zscaler, similar in that revenue growth was up by 23%. But as you noted, it was different in that the margin there, did expand. But overall, fundamentally, not really a lot of changes, in our outlooks.
So after all that, both stocks still look fairly valued. So there's no buying opportunity in either right now, right?
Correct. They're both rated 3 stars. In the case of CrowdStrike, it's trading pretty close to our fair value after the stock fell. And then as far as Zscaler, again, pretty close to our fair value after that stock price rose.
Now, we had a question come in from a viewer about Polaris, which has been an undervalued stock with a 5-star rating that, you and I have talked about before on the show. Now, the company reported pretty dismal earnings a few weeks ago and offered a weak forecast. So our viewer, Gerard, asked if Morningstar had changed the rating and the fair value estimate on the stock after the report.
So the rating is still the same. It's still a 5-star rated stock, trades at a 36% discount from our current fair value, and it looks like the dividend yield there is 5.6%. But we did take a pretty good haircut to our fair value, taking it down to $75 a share from 110. So again, I think generally, we knew and we understood and we incorporated within our model that there was a lot of pull forward during the early parts of the pandemic. But at this point, it just appears that it's taking much longer than what we originally expected, for the fundamentals really to improve. So the shares are still undervalued here, but just taking a look at the story, this might be one where it probably takes another couple of years, for it to really begin to play out. So this is probably better for, patient investors that can kind of wait out this, short-term period of, slower than expected fundamental improvement.
Now, as you pointed out, even after that cut in fair value, the stock still has a 5-star rating. Mm-hmm. So with the change in fair value, the rating didn't change. Can you briefly explain to viewers and listeners how that works?
Yeah, I mean, essentially, it's just as simple as, that stock was trading at a much larger margin of safety from our prior fair value estimate, which was higher. And at this point, it's still trading at a very wide margin of safety, but that margin of safety now is less than what it was before, but still enough to be able to put it in that 5-star range.
Got it. So you published your new stock market outlook, Dave, which viewers and listeners can find on morningstar.com. Now, just as we've seen a market rotation in terms of value versus growth this year, we've also seen a rotation in the markets this year by sector. So recap that for us.
Yeah, and a lot of that does have to do kind of with growth stocks overall selling off and value stocks appreciating. And just depending on where those stocks are within, the different sectors, generally we've seen our sector valuations, consolidate towards fair value. Essentially, overvalued sectors have become less overvalued, undervalued sectors less undervalued. So, for example, taking a look at like healthcare, real estate, basic materials, those were some of the more undervalued sectors at the beginning of the year. Each of those now has moved closer towards fair value. And then among the overvalued sectors at the beginning of the year, for example, like consumer cyclical was the most overvalued and has since dropped all the way towards our fair value composite.
Now, you say in your outlook that there are a couple of sectors that have kind of bucked those trends. Which ones are they?
Yeah, I mean, bucking the trend that we've seen thus far is going to be the communications sector and consumer defensive sector. Now, communications has become more undervalued following a couple of pretty notable increases in our fair values on stocks such as Alphabet and Meta. Of course, those are by market cap, the largest stocks within that sector by percent. And then consumer defensive has also become further overvalued. It's now the most overvalued sector at a 17% premium. But again, I also have to note that the 3 stocks in that sector that account for the greatest percentage of the market cap within the sector are Walmart, Costco, and P&G. And each has risen 7%, 12%, and 9% through the end of February. But those are 3 stocks that we think are pretty overvalued. Walmart and Costco both being 1-star rated stock, P&G being a 2-star rated stock. So once you get away from those 3 companies within the consumer defensive sector, we actually see a lot of value there. So this is one where it's kind of really much more of a stock picker's market, looking for those companies in consumer defensive, such as a lot of the food companies that we think are undervalued today.
So consumer defensive stocks as a group look overvalued. What other sectors look overpriced today?
First, I've got to point out the financials trading at a 14% premium. In this case, a lot of the big mega U.S. banks are trading at high premiums like J.P. Morgan. The insurance companies we also think are trading too high at this point. Utilities still a bit overvalued at an 8% premium. And then lastly, the industrial sector at a 4% premium.
Now, you mentioned that the communications sector has actually become more undervalued. So any other sectors look like bargains today?
Yeah, I still like energy at an 8% discount, a lot of opportunities there, and real estate at a 6% discount, although I would be a little bit more stock selective in the real estate sector, probably still steering clear of the urban office space, but looking for the real estate that has much more defensive characteristics.
All right. Well, we've arrived at the stock picks portion of the program, and your picks this week are undervalued stocks of companies that have economic moats and decent yields, and that look like opportunities in a market where there's a lot of noise, like today's market. Your first pick this week is Verizon. Run through the numbers on it.
Yeah, so Verizon's a four-star rated stock. Again, it just popped 4% last Friday. I don't know if that's just a matter of people looking for kind of a value-oriented stock with a high dividend, but at this point, it's still at a 13% discount to fair value. The dividend yield now has slipped below 6%, look like it's at 5.9%, but it is a company we rate with a narrow economic moat based on its cost advantages and its efficient scale, and a stock we rate with a medium uncertainty.
And as you mentioned, Verizon stock was up last week, but it's also up 17% this year. Not too shabby. Yet it still looks undervalued. So what do you think why do you think the stock has more room to run?
Yeah, and we've recommended both Verizon and AT&T stock a number of times. I think the first time we really reviewed both stocks was in spring of 2023, and we've kind of reiterated our recommendations there a couple of times. Although I'd note at this point AT&T has moved up enough that I believe it's a 3-star rated stock. So the original thesis here was that the wireless business overall was becoming much more like an oligopoly, that over time we expected them to compete less on price, that would then allow margins to expand. And that has been coming to fruition. Since our first recommendations, AT&T has just well outperformed Verizon. It just appears that the market prefers AT&T's strategy of building out their own fiber assets as opposed to buying them, which is what Verizon has been doing. But either way, over the longer term, I still think that really it's going to be the same kind of factors that affect both companies. And in fact, with as much as AT&T has moved up, I wouldn't be surprised to see some investors that maybe swap out of AT&T into Verizon instead. In my mind, that swap makes sense. You pick up yield and you buy at a greater discount to fair value. Looks like Verizon reported earnings, in January. I think our kind of takeaway here was that they were solid, although not necessarily anything to write home about. So in my mind, I think this is just a solid value stock pick with a great yield carry at this point.
Now, your second pick this week is First Energy, which also has a pretty attractive yield.
Yeah, 4-star rated stock, 12% discount, 4.4% dividend yield. Like pretty much all the other regulated utilities, narrow economic moat and a low uncertainty.
Now, the utility sector is overvalued, yet First Energy looks undervalued. So what's the market missing here, Dave?
We're just missing just how focused the company is on accelerating investments that should result in solid earnings growth, over the long term. I think our current model is that we expect, First Energy to invest, $26 billion through 2028. That's a 40% increase from their previous, 5-year capital investment plan. So that just supports our expectation that the company can achieve at least, the midpoint of the management's, annual earnings growth targets. Specifically, this company serves states like Ohio, Pennsylvania, New Jersey. We think overall Ohio and Pennsylvania have higher probabilities of seeing new data center build-outs in order to support AI. I mean, they just have relatively strategic locations, economic incentives, and the infrastructure to do so. And somewhat similar to Wisconsin, and again, we've talked Wisconsin Energy or Wisconsin Electric, over the time as well. It's of course, easier to keep data centers cool, in the northern states than in the southern states. So I do think the company reports earnings here, relatively soon. There's always, of course, the risk that something unexpected comes up. But, we think it's probably more likely a higher probability of upside surprise than negative news.
Now, your next pick this week is U.S. Bancorp. Walk through the key metrics on this one.
4-star rated stock, 16% discount, 4.5% dividend yield. We rate the company with a wide economic moat. And in fact, I think it's the only regional bank that we rate with that wide moat, and it has a medium uncertainty.
Now, here again, we have another example of a stock in an overvalued sector, and in this case, it's financial services, that looks undervalued. So how does Morningstar's thesis on U.S. Bank differ from that of the markets?
Yeah, and actually, I mean, I don't think we've talked about U.S. Bank, in quite a while now. I mean, this originally was, one of our better picks after the Silicon Valley Bank failure back in March of 2023. If you remember, at that point in time, the entire banking sector sold off too hard. There was a lot of very undervalued, bank stocks at that point in time. Over the time period, since then, the stock did move up enough that it got into 3-star territory by last fall. But what we've seen is, regional banks generally started sliding, earlier this year. And, even since mid-February, a lot of the U.S. mega banks, have been sliding as well. To some degree, I think the market is pricing in, fewer rate cuts than what we had expected or what the market had expected before. So again, you'll get less of an increase in net interest margins, over time. Plus, the market just might be getting more concerned that a softer and softer economy, could lead to higher charge-offs, as well. So in that environment, the regionals have fallen more than the mega banks, generally just because the regionals have fewer kind of, non-banking revenue streams, as such as like investment banking that you'd see at the large banks. And then specifically looking at US Bank, it does have some of this fee income though that we think will help provide better downside protection than the other regionals. So they do have revenue from corporate trust fees. They have a pretty strong deposit franchise. And just fundamentally, we think it has, one of the best operating efficiency ratios according to, our numbers, compared to the other regional banks. So again, US Bank, in particular, I think the market might be a little apprehensive following the announcement of a transition of the CEO. There was no prior retirement timeline, given for that, but we're not as worried. The new CEO is coming from within the company, and we don't think it'll be, too disruptive to their operations.
All right. Well, then your last stock pick this week is an undervalued stock from the consumer defensive sector. It's Clorox. Tell us about it.
So 4-star rated stock at a 13% discount, 3.2% dividend yield. Again, a company we rate with a wide economic moat based on its intangible assets and its cost advantages, and a stock we rate with a medium uncertainty.
Now, Clorox stock peaked during the pandemic as we were all hoarding the company's cleaning products, and the stock has since pulled back. So why is this a pick today?
I mean, to some degree, I'm literally thinking about this as being a normalization play. I mean, as you mentioned, initially, had just outsized growth, those first couple of years, after the beginning of the pandemic. And, it's given back, a lot of that growth, ever since then. Then, of course, you had to deal with, all the shipping issues, the supply bottlenecks in 2022. Unfortunately, the company did suffer from a cybersecurity breach in 2023, which, took some systems offline for a while. Again, just another good reason for owning some of those cybersecurity stocks. But yeah, and then thinking about what happened in 2024, the company did have to increase, their promotional spending just to be able to maintain, their brand strength, which, our analyst has noted she thinks that is working. In fact, the Clorox brands are holding up, pretty well here in the short term, even in the face of, heightened competition from private label brands. So we think that indicates that consumers do give, added economic value to the Clorox brands. And just generally, when I look at that stock price, it's essentially now unchanged from, where it was trading, pre-pandemic. So it's done pretty much a full round trip, at this point in time. Took a quick look at our model this weekend. We're really not predicting, any big, huge, shifts here. We're looking for top line growth kind of in that low single-digit percentage area. We are looking for some slight operating margin expansion, over time. Now, the company is, or the stock is trading at 21 times its midpoint for 2025 earnings guidance. Now, I would note their fiscal year end is here in June. So kind of once we get closer to that, then I think the focus will be not so much on kind of that forward multiple for fiscal 25, but the forward multiple for 2026, which at that point in time should be below 20. So from that market point of view, I think it will look more undervalued at that point in time. Now, historically, not necessarily really cheap here, but when you look at kind of where it's traded on a historical basis on a valuation, it does look undervalued to us here. And then lastly, as far as Tariff goes, Erin Lash, who covers the stock for us, did write in her last note that she didn't expect that, tariffs would have much of a negative impact, on Clorox. And then lastly, I have to note too, it does have a pretty strong balance sheet. So if we are going into any kind of downturn, this is a stock and a company that should be able to weather any kind of, economic noise over the next couple quarters.
All right. Well, thank you for your time this morning, Dave. Those who'd like more information about any of the stocks Dave talked about today can visit Morningstar.com for more details. We hope you'll join us next week for a new episode of The Morning Filter on Monday at 9 a.m. Eastern, 8 a.m. Central. In the meantime, please like this episode and subscribe. Have a super week.